Hey folks, I've said it before and I'll say it again. We are in, to some degree, an AI bubble, and it is incredibly apparent, but it won't stop me from investing because it's relatively secular. And on this channel, I try and focus on the stocks that I believe are fair valued, ones that give me exposure to major AI upside, but with none of the valuation risk. And I want to explain to you what I mean by that, because obviously with earnings this week, the markets have gone virtually nowhere, even though you can go on to like Gemini, and I've seen reports that one report reflecting data as of October 29th stated that of the 222 S&P 500 members that had reported, 83.8% beat estimates. So we're beating analyst expectations, and it goes to show maybe a lot of this has been priced into the broader markets. And if you take a look here, guys, I mean, we had Google that beat, Meta that could have beat, but had that one-time tax expense that completely drove the stock down. Regardless, I'd always prefer earnings going up, revenues going up, and the stock prices coming down. This is how you get rich in the market. You don't want to be buying when everyone and their grandmother's loading into some of these individual stocks. That's why I picked up a few Meta shares this week. But I mean, you look at the Canadian markets and the US markets, and there's just not a lot going on, guys. We're seeing gold retrace a bit down to 4,000 an ounce, kind of bringing down the precious metal sector here in Canada. The banks don't report earnings until November, December. So we're not going to see a lot of earnings out of Canada. And in the US, it's mostly tech that has bolstered the broader markets. But because everything else is just down this week, it kind of, dampened the earnings dampened the broader earnings of the S&P, even though a lot of these lower half companies beat expectations, guys. So again, this is a good opportunity for those that are hand selecting stocks. But if you're buying indexes, this is still a great opportunity again, I know people are going to tell me that it is still a very expensive and overvalued market, but again, it can hold higher valuations as long as earnings expectations keep crushing it and there's no black swan. There's no, there has to be some kind of economic circumstance that drives down earnings expectations that will completely correct the market like we did in 2022. That's how bubbles form, right? You just get a really good period of no crazy economic events and continue. I mean, look at the tariff war. Look at how fast that brought the market down, right? Until we realized it wasn't really going to affect earnings as bad, and it wasn't going to be like a widespread effect across the entire market. Yet the fear and greed index is still sitting at extreme fear. I'm still pretty confident with forward PE right now is hovering around 23 for the S&P 500. Again, I think we're expensive, but I think it's starting to justify some of those expensive realities, and that could just mean we go into a flatline market for a little while, right? But let's talk about where I think the bubble is, and when the bubble bursts, the stocks that are going to correct the most. And I know I'm going to get a lot of heat for this. Again, if I'm wrong, I'm wrong. I've been wrong in the past. I haven't been able to collectivize the returns of these stocks. I've missed one of the greatest bull sectors basically of this decade, which is, again, some of these AI stocks like NVIDIA and Palantir. But I want to talk about Palantir. I haven't talked about it in a while, and even still, I put it aside. I don't talk about it, and as time goes on, the valuations continue to excel in this company. And again, I wasn't comfortable buying it at $100, and I'm sure as hell not going to be comfortable buying it at $200 when the price to earnings on Halloween of all days is at 666, guys. I just want to talk about how insanely expensive this company truly is, and all the other opportunities out there that you could choose over Palantir. Yet investors are still flocking into this mostly retail health company. And I always feel like retail gets the most burn when we go into downturns, because it is companies like this that can get destroyed. I'm going to explain to you why before you give me too much flack. But first, let's just look at the valuation. Yes, it's growing at an incredible rate, 48% for the last quarter, guys, but it's trailing 12-month revenue, $3.44 billion. And again, I want you to focus on this valuation, almost a $500 billion valuation. I mean, Adobe's almost one-fifth the value of Palantir. And I want to remind you here, this company's growing at about 10%, but its trailing 12-month revenue is $23 billion, guys. Let's look at Shopify. This one's worth, just around half as much from the Canadian valuation. It's about half as much as Palantir. And even this company is growing at a 30% revenue clip and is doing $10 billion in trailing 12 months, 3 times that of Palantir. Again, I'm just showing you these comparable software companies just to wrap your head around. Even if you think Palantir has explosive growth into the future, if you're buying it today, you are waiting at least 5 years for the valuation just to justify for what you're paying today. And in that 5 years, if we have any economic hiccups that slow the economy down, this stock will get absolutely devastated. And you can't tell me when you're comparing it to the likes of Google and Meta that, yes, I mean, they're not growing at 50% clips on their revenue, but still 20, 30% earnings growth rate, guys, at price to earnings of 28. Meta right now trading at a I'm just saying, like, I'm not saying Palantir is a bad company. Fundamentally, it is an incredibly strong company. It is just the raw valuation metrics. I mean, Meta trading at a 28, which doesn't justify because their earnings had a one-time tax expense. So even though their price to earning jumped up, it's still going to be materially lower moving forward here. I don't know. I like these companies. Just again, I'm a value guy at the end of the day. If I can get the AI and the data centers and everything that Google and Meta are investing into at a fair price to earnings for their current underlying business growth, that's what I'm going to pay for it, guys. And even with Tesla, like, I think Tesla's an exemplifier of, we're into a retail bull market that is extending its value, because Tesla has no reason to be trading at $450. You can argue this all you want, but guys, like, come on. I mean, when we looked at the earnings that just recently came out, I will say the revenue did bump up. I think they did 28 billion, which was a record revenue quarter for them. But it did not justify anything to the bottom line. It doesn't matter if you're making all this revenue, guys, if you have no margin to capitalize on it, right? And I get it. This company always has something new, another flagpole they can push further out into the future to keep people hyped into it, even though their auto business is losing massive, sector exposure or addressable market exposure to the likes of BYD and companies that are doing substantially better in auto, cars and just building them out and getting global sales out of them. But if you take a look at the net income here, guys, this is what really is kind of insane, is 1.3 billion. The net income, if we just take a look here on Tesla here, that net income of 1.3 billion is like of some of the worst earnings they've ever experienced since they became profitable back in 2020. And I want to point out that pushing the goalpost down the road comes back to the same conversation, guys, that if we go into an economic hiccup, which technically happens once every several years or so, it would completely devastate and just cause massive volatility to the downside. Again, we saw that with companies like Tesla coming through 2022. I mean, the stock dropped down 70%, guys. This will happen again, and you just have to understand the exposure you're getting and how long it might take for a stock like this to recover. Again, we've done an exceptional job and had a lot of luck of the stock recovering back to those highs of 2022, but the returns, if you've been buying these tops, have been incredibly bleak over the last 5 years. And I mean, Marques Brownlee did a great job just talking about, I personally hate companies today that never really follow that Apple, presentation, like the idea of like, let's make an incredible product that is ready to be sold, and then we'll announce it. So a month or two later, people can order it and it's being delivered to their doors. What we're getting now is this new Tesla model, where it's this Tesla business model, where it's like, let's produce a product that isn't going to be functional for probably a decade, and we're going to start selling it now. And you can't tell me that's not true, guys. I mean, look at the Tesla Roadster. It has almost been a decade, and they were taking $250,000 deposits for those cars, and they still don't exist. Self-driving, I was told in 2019 would be ready at the end of the year. It is only just now starting to brink the regulatory environment, right? Like, I mean, just take a listen. This is the same thing with robots all over again.
For a lot of people, and it's available to order now. This is available to order. This feels like it could be the best tech announcement of all time in 2025, except this isn't real. And I mean that in the most literal way possible. This is not real. First of all, it's a pre-order. So you can go to this website right now and you can pick between 3 colors, and then it's either $500 a month subscription for a standard delivery, or you can pay a flat $20,000 to own it outright and get priority delivery. Just drop a $200 fully refundable deposit to get in line today, and deliveries in the US start sometime next year. And that's just allegedly. We don't know when it's actually going to ship.
This robot can't do half the stuff it's promising today. Think about how complicated it was to build out the infrastructure for self-driving cars that still now is only just starting to brink regulatory environments. Google kind of starting to slowly scale here. And imagine now you have dozens of moving parts on a humanoid robot that has to somehow go through the same training models, but it's going to be 10x the fold of data required. Yet it's not like a car where it's out on the street. Like, if these are not in people's homes, if they're not being trained on that extensive amount of data, how is it supposed to scale anytime soon? Like, there's a lot of red flags and concerns that I just can't get over. And even Marques was pointing out the fact that, like, there's a big problem here, guys. Like, how are we selling these things for these kind of values that just will not be implemented in any severe way like obviously anytime soon. I really hate this idea of product build out, but again, for those that want to be, part of this early growth phase, and hope it works out and it doesn't end up in the back office or the back closet somewhere, congrats. I get it. If you want to be a part of that, great. But as an actual valuation metric behind a company, to me, it's just ludicrous today. And it's all priced in with a company like Tesla. Like at a 301 times, like almost a $1.5 trillion market cap value here, guys. Like I said, we could get there. And I'm not saying we're not going to get there. I'm just saying I'm not willing to pay that today as though it exists. And that's what you're doing when you're buying companies like Palantir and Tesla. Like you're buying 5-10 year value metrics that don't exist today. And I just don't trust that we're not going to go into some economic downturn that will absolutely crush stocks like that. Like even Meta, companies that had great earnings and revenue, guys, just remember individual stocks can have massive risk exposure and drop precipitously. 73%, like nothing short of insane. I mean, Google, what did it drop back in 2022? I mean, this one went down about 30 or 40%. So just remind yourself of what you're giving yourself exposure to and understand the volatility risk that you're giving to your portfolio, guys. This is why I'm mostly focused on indexes, because they naturally will sort and weight these companies out over time. And yes, though it could hinder my ETFs, long term, naturally, the companies that are winning will start to, surface themselves to the top. And I'll pass that question off to you guys. I just love to know what you think about this broader market environment, how you feel about your portfolio in it. Are you buying Palantir? Are you comfortable buying Tesla here? Again, I'm not saying I'm right, could be completely wrong, but I'd love to hear about all of it in that comment section below.